Nearly 20 years ago, Germany overcame its reputation as the sick man of Europe, armed with ambitious labour market reforms that unshackled its industrial potential and ushered in a sustained period of prosperity, driven particularly by strong demand for its machinery and cars from China. While Germany frustrated many partners by exporting vastly more than it was buying, its economy flourished. The boom times, however, came with a cost. The economic strength led leaders into a false sense of security, and their failure to pursue further reforms is now coming back to bite. The perfect storm brewing over the once European powerhouse signals that its current recession isn't just technical, as policymakers had hoped, but rather an indication of a fundamental reversal in economic fortunes that threatens to send tremors across the continent. For 70 years, the German business model was successfully based on the import of cheap raw materials and energy, and their processing and export as expensive high-end products all over the world. During this period, Germans benefited greatly from high revenue and trade surpluses. However, the success of this business model presupposed free competition in all markets, politically unhindered imports and exports, and cheap raw material and energy imports that were always available. Due to the ongoing war in Ukraine and its consequences, this business model is no longer feasible. Without sufficiently cheap energy, the German industry is no longer competitive on a global level. Confronted by a concoction of high energy costs and worker shortages, many of Germany's biggest companies, from giants like Siemens and Volkswagen to a host of lesser-known ones, are experiencing a rude awakening and scrambling for greener pastures in Asia and North America. It's hard to avoid the fact that Germany is headed for a much deeper economic decline, and the reports from the front lines are only getting worse. Unemployment rose by about 200,000 in June last year, a month when companies normally add jobs. Although the overall unemployment rate remains low at 5.7% and the number of job vacancies high at nearly 800,000, German officials are bracing for more bad news. To understand the long-term effects of de-industrialization, one need not look further than America's Rust Belt or the UK's Midlands, once thriving industrial corridors that fell victim to policy missteps and global competitive pressures and never fully recovered. Only with Germany, the consequences would play out on a continental scale. The erosion of Germany's industrial core is expected to have a substantial impact on the rest of the European Union. Germany is not just Europe's largest player, it also links the region's diverse economies as the largest trading partner and investor for many of them. While EU officials have blamed the region's looming deindustrialization on what they see as unfair policies in the US and China that place European companies at a disadvantage, the problems in Germany run much deeper and are largely homemade. Simply put, the formula that made Germany Europe's industrial powerhouse, a highly skilled workforce and innovative companies powered by cheap energy, has come undone. As a generation of baby boomers retires in the coming years, Germany is speeding toward a demographic cliff that will leave its companies without the scientists, engineers, and other highly skilled workers they need to stay competitive in the global market. Within the next 15 years or so, it is expected that about 30% of Germany's workforce will reach retirement age. So far, any efforts to compensate for the growing worker shortfall through migration have failed. Compounding those demographic challenges are skyrocketing energy costs in the wake of Russia's war on Ukraine, and Germany's own efforts to combat climate change. The country's green transformation, the so-called Energiewende, has only made matters worse. Just as it was losing access to Russian gas, the country resorted to switching off all nuclear power. We can't fail to mention the country's industrial backbone that's facing unprecedented strain. Long a source of national pride, the car industry can be labelled Germany's soft underbelly for reasons that have more to do with pride than the country's structural deficiencies. For years, companies like Mercedes and BMW refused to let go of the combustion engine, dismissing Tesla and other early innovators as short-lived. That strategic blunder opened the door not just to Elon Musk, but for China, which began investing substantial sums in electric vehicle development 15 years ago. In 2023, Chinese producers accounted for about 60% of the more than 10 million all-electric cars sold worldwide. And right now, the Germans are already feeling the effects of their miscalculation. Despite the country's industrial exodus, Germany's politicians are largely in denial about the looming political and economic challenges. The German industrial lobby has said that heavy industry should start recovering in 2025, but that assumes energy prices will fall to previous levels. At some point, Germans will wake up to the dangers they face. The question is whether or not they will before it's too late.